Hi, welcome to MMT Mondays on Real Progressives. I'm Jeff Ginter, your host. Some of you may know, some of you may not. I don't know. I'm a musician, and tonight I'm inspired by Bill Medley of the Righteous Brothers. You've lost that loving feeling. Unchained melody for those that love movies that deal with pottery. Blue-eyed soul, baby. Oh, it's awesome. One of the singers for the Righteous Brothers is named Bill Medley, and that's what we're doing tonight. We are having a Bill Medley. We're having a Bill Black medley. A couple of different videos, one TED Talk, and is of Bill Black. The awesome Bill Black, William Black, professor of economics and law at UMKC. If you're looking for a bank regulator, if you're looking for someone to explain all these financial crashes that we've had that have dealt with bank fraud, you're not going to find anyone better than Bill Black to be able to take you by the hand and walk you through the process of what happened and what we could do about it. And once you've seen these things, I hope you understand that with the knowledge of MMT, we don't need to raise money to be able to fund federal programs. What's the FBI? It's a federal program. The Department of Justice is a federal program. If we want to be able to prosecute these bankers, and we don't do it because, well, we don't have the resources, we don't have the FBI members with expertise, we don't have enough lawyers to be able to go after them, I'm sorry. We have the resources. The federal government can choose to build its army, build its defenses, build the FBI to do certain things. The FBI is an instrument. It can be used to bludgeon you, or it can be used to work for you. It's a decision. It's a choice. For most of my lifetime, the FBI has been the enemy, and quite honestly, it's been used in bad ways to protect oligarchy and destroy anyone that threatens oligarchy. But it doesn't have to be that way. Oligarchs control government. Ergo, the FBI, the Department of Justice, dominantly works for them. And to the degree that it works for you, it's largely window dressing. Just enough scraps so that you feel like it's not that horrible an institution. Case in point, the prosecution of Donald J. Trump by the Democrats. Suddenly, we love the FBI. The FBI is going to save us. Hopefully, the fact that these two things are coexisting side by side gives you a window into understanding that these institutions are just tools. How those tools get used is what's really at issue. So when the federal government, complains, that it doesn't have the resources to fight banking corruption and bank fraud, it's choosing not to. It cries poor. It says it doesn't have the financial resources to train and hire the people to actually be able to successfully prosecute these cases. That's a political choice. It has all the money it needs. As Warren Mosler says, the federal government neither has nor does not have money. Congress appropriates the money, the president signs it, the Treasury and the Fed coordinate to make the payments. So you want to expand the Department of Justice so that it can properly prosecute bank fraud? Choose to do it. That's all it is. It's a choice. And if you think that the Congress is going to choose to do that on its own, it's not going to happen. The choice is not Congress's. The choice is yours. Do you want to have bank fraud prosecuted? Do you want to have banking regulations to make sure that banking works for us? You're going to have to make the choice that that's what you want, and then you're going to have to make the choice to stand up and fight for it and demand it of Congress so that Congress will make the right choice based upon the pressure that is brought to bear on them. Right now, that's the way it works. That's the way it always works. That's the way it will always work. Congress responds to pressure. Right now, that pressure comes almost exclusively from Wall Street, from oligarchy. But we outnumber them. If we bring the actual pressure, if we become the real power, then they will respond to us. It's not happening right now, but that's a choice. Our choice. What choice are you making? Be back in a bit.
Hello, I'm here with Professor William Black, an Associate Professor of Economics and Law at the University of Missouri at Kansas City. Bill, great to have you with me this morning.
Thank you.
You have been at previous INET conferences. This is the first time we've actually had you speak, I believe, and we've jokingly said that finally we're allowing the F word, the word that the economists dare not speak, be addressed in this conference. By that I mean fraud. And of course, you've done a lot of work on that, particularly the area of control fraud. So do you want to briefly describe what that's all about?
Sure. Control fraud is what occurs when the person who controls a seemingly legitimate entity uses it as a weapon to defraud. And in the financial sphere, their weapon of choice is accounting, and control frauds cause greater financial losses than all other forms of property crime combined.
Now, you were actually a practitioner in the sense that you were an investigator during the savings and loan crisis. How would you compare the response that we've had post the great financial recession of 2008 to how we dealt with the savings and loans crisis?
Right. So there has been essentially no response from the criminal justice system to the current crisis. There was quite a delayed response to the savings and loan crisis. It was actually helped by congressional actually holding a hearing, a substantive hearing, and saying, you should be actually investigating and making criminal referrals and making a high priority of going after these criminals. So that was Doug Barnard, a former banker, and probably disappeared from history. But that helped embarrass the agency and the Department of Justice and the FBI into getting very serious. And they created a criminal referral system that in just our agency, which became known as the Office of Thrift Supervision, so this is regulating savings and loans in the heart of the savings and loan debacle, made over 30,000 criminal referrals, eventually produced over 1,000 felony convictions just in cases designated as major. And that really understates the degree of prioritization because we created, with the FBI, a really serious process, the top 100 list of the worst fraud schemes, which involved 300 savings and loans and roughly 600 individuals. And they were virtually all prosecuted with a 90% conviction rate against the best criminal defense lawyers in the world. So that's the most successful criminal justice response to elite financial frauds in world history. Flash forward to the current crisis. Same agency, Office of Thrift Supervision. This crisis is 70 times larger. Just in terms of household losses, if you measure it by productivity losses, lost GDP, it's something like 150 times larger than the savings and loan crisis. And that same agency made zero criminal referrals. It was supposed to regulate Countrywide and Washington Mutual and IndyMac. These are all massive entities pumping out fraudulent loans literally by the hundreds of thousands. And collectively in the millions. So there have been, as we speak, zero prosecutions. I'm not even talking about successful prosecutions. There have been zero prosecutions of any of the elite bankers that actually drove the fraud epidemics that caused this crisis. And it isn't just the elites. So if you look at the small mortgage banks, or even fairly large but obscure mortgage banks, these are not the Wall Street guys, they too skated in terms of prosecution. And it isn't just the Office of Thrift Supervision. The Office of the Comptroller of the Currency, which is supposed to regulate national banks, the Federal Reserve, both ceased making criminal referrals, and the FDIC is smart enough to refuse the answer to the question of how many referrals it made.
And the person who has answered this, Eric Holder, the Attorney General, has basically said, well, we haven't found any evidence of fraud or wrongdoing.
Actually, he hasn't said that. He said vague things that can be interpreted sort of kind of that way. But he's never been pinned down. And he has never given that kind of flat answer. What he has said unequivocally, though he backed away from it very quickly, was that the really huge banks were too big to prosecute. And his head of the criminal division, Lanny Brewer, who has since resigned, many people would say in disgrace.
He made that point explicitly, I think, on a PBS program dealing with this.
He did, and he also was asked about a prior speech he had given to a bunch of lawyers in New York representing the biggest banks, in which he talked about how he lay unable to sleep at night for fear that he might harm a large bank, which it's hard to see how that fear, since he never did anything to the large banks.
It makes one almost long for Alberto Gonzalez, who I pointed out at least prosecuted the Enron guys, actually.
Well, indeed, there are numbers on all of this, and from the savings and loan days, where most of the prosecutions occurred under the first President Bush, through the Clinton era, and then Bush 2, and now to Obama, there's been a steady decline. And we are at well under half the rate on sort of all elite white-collar crime. So when 9/11 occurred, they transferred over 500 FBI specialists from doing white-collar to doing national security. And national security became literally priorities 1 through 9. So 10 is everything else, and in that list, financial fraud is pretty far down. And since it was their highest priority, of course, they were trying to transfer the absolute best FBI agents out of white collar. And since they knew they couldn't infiltrate Al-Qaeda, they weren't looking for those kinds of FBI specialists. They were looking for folks who could follow the money, as we say. In other words, the most financially sophisticated FBI agents. So they not only took the best agents, but they took the best agents with the skill sets that were critical to dealing with these cases. We're now left with right around 2 FBI agents that do white-collar crime investigations per industry, not per corporation. And, of course, banks don't make criminal referrals against their own CEOs. So the only way you're going to get a prosecution, FBI agents, there's 2 per industry. A, they can't have industry expertise. And B, they obviously can't walk a beat or they'd never find anything. So they only go when there's a criminal referral. Criminal referrals have ceased from the regulatory agencies. Banks are not going to make criminal referrals against their own folks. You'll get a few episodically from whistleblowers, but it means that basically there is no system for even beginning to prosecute. Not just the big banks, but the smaller banks for the frauds. And by the time we're speaking, we're getting very near the effective end of the statute of limitations.
There was a proposal, I believe, by Representative Marcy Kaptur to use some government money to hire an additional FBI agent specifically to build up the agency to deal with this kind of a problem. Whatever became of that? Because you wrote about that proposal.
Yeah, and the Congress has gone the opposite direction. The House is in an unholy war. House of Representatives, the United States, is in an unholy war against the regulators, the SEC and the Commodity Future Trading Commission in large part. And again, these are the people that have to make the referrals, that have the expertise to allow the FBI and the Justice Department to do anything. They did not allow the FBI to replace the agents who were transferred to national security, and that's been under both the Bush administration and now the Obama administration. This, again, is in sharp contrast to the savings and loan crisis, where Congress passed two bills in 1989 and 1991 that mandated dramatic increases in staffing for the FBI and the Justice Department, and mandated that it be used to go after the savings and loan crooks. So I told you that before the 9/11, there were roughly 2,500 FBI agents. In the savings and loan crisis at peak, we had 1,000 of those agents assigned just to dealing with savings and loan cases. As recently as fiscal year 2007, there was a grand total of 120 FBI agents nationwide dealing with all cases involving the crisis. And they were doing Dick and Mary cases, some homeowner and maybe a real estate broker. They were bragging by 2008 that half of their cases were now $1 million. Well, that's 2 California houses and such. So it's a complete misallocation of resources. They haven't even begun to investigate the large institutions. They're unwilling to do so.
And even when they do investigate them, they come to these settlements where they don't really investigate. They pick a number out of midair, it seems, to settle, and it doesn't come anywhere near covering the economic damage.
And two other major aspects along the lines that you're talking about. Of course, the CEO handles the negotiations, and Jamie Dimon famously stepped in personally. Well, what are his interests? His interest is, first, they don't claw back my bonus, that I got massive amounts of money for producing fictional income. And he's happy to trade off a fine, right? And second, of course, the money comes entirely from the institution. The officers who caused the problem control the institution. So they're happy to trade off, we'll take a bigger fine, but you won't prosecute anybody. It's an immense conflict of interest. So the settlement process itself is both a demonstration of the problem and a worsening of the problem that ensures that the elite officers are able to defraud with impunity.
It's a very marked contrast to what we had in the 1930s when Jesse Jones, when he was heading the Reconstruction Finance Corporation, not only did he shut down a number of banks, but he demanded letters of resignation from all of the CEOs, and he put them in his filing cabinet there to be used in the event that he needed to use them.
That's true. And in the savings and loan crisis, we put something like 600 savings and loan in a receivership, got rid of the people, went after them if they engaged in fraud, tried to leave them penniless in those circumstances if they engaged in fraud, and made the criminal referrals and made over 3,000 enforcement actions that were often real, where we were directing at the officer as opposed to at the, what does it pay to go after a bankrupt bank that you're paying for anyway through the insurance fund? There's no real recovery in those circumstances. And the SEC in the modern era gets almost entirely useless consent decrees, and disproportionately it goes after the dead, who are never going to issue a security again. And then, all they get is something that says, if we ever issue securities, we will comply with the securities laws. Well, you have to comply with the securities laws anyway. And we're speaking shortly after the longtime SEC enforcement attorney has resigned at his retirement party
Robert
with his
Kazami.
blast,
Yes.
saying that my bosses, A, are afraid to go after the big guys, and B, that they don't want to because of the revolving door, that if you're too vigorous, you hurt your job opportunities. And you can see this in the context of the SEC, where about 20% of their cases on enforcement are just pure fluff that are created solely for purposes of numbers.
And in fact, people who did their jobs rather too well are unemployable right now. You've mentioned the case of Ed Gray, for example, as one very poignant example.
That's right. Ed Gray was the chairman of the federal agency that regulated savings and loans. He was appointed, he was quite told this by the Industry Trade Association because they believed that he would be friendly and malleable and such, and became the great re-regulator. And that is the primary reason. If we back up a second, when I used to write about the savings and loan crisis and about the savings, I thought they were large, but $1 trillion. But of course, we didn't have the advantage of the current crisis, where people failed to regulate and did the opposite in many ways for over 15 years. if you'd had the same response to the savings and loan debacle, it would too would have been measured in the many trillions of dollars. Ed Gray began re-regulating 1 year after the federal deregulation bill, the Garn-St. Germain Act of 1982, went into effect. And that was a bipartisan bill with very strong support. So we were opposed in those efforts by the White House, which at one point threatened to make a criminal referral against Ed Gray on the grounds that he was closing too many insolvent savings and loans. Can you imagine that in the modern era?
Actually, I can, sadly.
Well, I can't imagine the regulator getting to the point where he has to be threatened, unfortunately. And he take on the leadership of both the Republicans and the Democrats in the House and the Senate. The Speaker of the House, very powerful Speaker Wright, held hostage our bills expressly, trying to extort special benefits for the frauds. The famous 5 U.S. senators became known as the Keating Five. The Trade Association political scientists in America called it the third most powerful in the United States of America. And of course, the trade press, the business pages, hated us. The re-regulator was the greatest insult they could muster. We obviously were atavistic idiots that didn't understand modern economics and such. So Ed Gray is unemployed and unemployable, and we're now talking about over 30 years since he's done this. Our top supervisor in Texas, which was our worst place, was forced to resign, and the new head of the agency, Ed Gray's successor, who was appointed to be the anti-Gray, took public credit for it. Now, this is the most distinguished supervisor in America. He had been the former head of the Office of the Comptroller of the Currency on an acting basis as a professional who came up through the ranks over 20 years and then had this incredibly impressive record at the savings and loan. And the head of our agency forces him out because Speaker Wright wants him out, claiming that he's a homosexual, sending all the work to homosexual lawyers. Right? I mean, just insane things from that era where lots of people lost their careers entirely because they were willing to do the right thing. And it meant, we now know, savings of many trillions of dollars.
Now, one final question. You have jokingly said that economists don't address the F word fraud in their own analyses. You, of course, are both an economist and a lawyer, and a criminologist, so you look at these things. Do you think that's changed? And what's been the rationale why economics has dealt so poorly with the issue of fraud?
I don't joke. I make an observation that there is a primitive tribal taboo among economists. So if you go back, classical economics understood fraud and all said that one of the key things that a government has to do is provide a rule of law and a police force and an anti-fraud. Ayn Rand, von Mises, von Hayek said that you had to deal with fraud. Along comes neoclassical economics, standard assumption, information is perfect, cost-free. Well, you can't have fraud in those circumstances. So it would be, to ask an economist, neoclassical economist, about fraud, it would be equivalent to asking a zoologist to tell you about unicorns, right? It can't exist. It's a fictional beast and such. Law and economics was even worse when it came along, what we call theoclassical economics, where it's a pure religion. So the famous thing that now a generation of lawyers has been taught in America from this treatise that I'm about to quote from, it says, a rule against fraud is not necessary or even particularly important.
Which is, I think, the comment that was made to Brooks Lee Bourne when she went after tried to go after some of the banks
and by Alan Greenspan in their very first meeting, where he said that you and I are clearly going to disagree, which he thought was a fairly strange line to someone you just met. And he said, you probably think that fraud is a basis for regulation. And, so she got that look you get when you're trapped in an elevator with a crazy person type of thing. Unfortunately, all the world was trapped with a crazy person who was in charge of the levers at the Federal Reserve. And he proved to completely ignore fraud. And if he hadn't, there wouldn't have been a financial crisis.
Do you think that might change under Janet Yellen, especially given that her husband is George Akerlof?
Well, we've just had a talk that explained that what things that Joe Stiglitz has been saying for 20 years have not been incorporated by neoclassical economics. And the perfect example of something akin to that, of course, is someone who got the Nobel laureate in the same year for similar work, and that's George Akerlof, and Janet Yellen's spouse. And Akerlof explained how this looting occurred, how this fraud mechanism occurred, and the response of the person who was the leading economics textbook writer in America now, in the world actually, and Gregory Mankiw was, and I quote, "It would be irrational for savings and loan executives not to loot."
Unfortunately, that's true, given the fact that he didn't seem to be getting prosecuted this way. And as you pointed out, the best way to rob a bank is to own one in your own book. So.
True, and the title of the Akerlof and Romer paper in 1993 is "Looting the Economic Underworld of Bankruptcy for Profit."
Yep.
But Akerlof and Romer and I thought there might be a moral content to this.
Yep.
Mankiw, not so much.
Well, maybe things will change now that we have Ms. Yellen at the head of the Fed. One can hope so. Bill, as always, it's great to speak to you. It's great to see you, and very much appreciate sharing your insights with us this morning.
Thank you for the opportunity.
So today's Top Chef class is in how to rob a bank. And it's clear that the general public needs guidance because the average bank robbery nets only $7,500. Rank amateurs who know nothing about how to cook the books. The folks who know, of course, run our largest banks. And in the last go-round, they cost us over $11 trillion. That's what 11 trillion looks like. That's how many zeros. And cost us over 10 million jobs as well. So our task is to educate ourselves so that we can understand why we have these recurrent, intensifying financial crises and how we can prevent them in the future. And the answer to that is that we have to stop epidemics of control fraud. Control fraud is what happens when the people who control, typically a CEO, a seemingly legitimate entity, use it as a weapon to defraud. And these are the weapons of mass destruction in the financial world. They also follow in finance a particular strategy because the weapon of choice in finance is accounting. And there is a recipe for accounting, control fraud, and how it occurs. And we discovered this recipe in quite an odd way that I'll come back to in a moment. First ingredient in the recipe, grow like crazy. Second, by making or buying really crappy loans, but loans that are made at a very high interest rate or yield. 3, while employing extreme leverage, that just means a lot of debt compared to your equity. And 4, while providing only trivial loss reserves against the inevitable losses. If you follow those 4 simple steps, and any bank can follow them, then you are mathematically guaranteed to have 3 things occur. The first thing is you will report record bank profits, not just high, record. 2, the CEO will immediately be made incredibly wealthy by modern executive compensation. And 3, farther down the road, the bank will suffer catastrophic losses and will fail unless it is bailed out. And that's a hint as to how we discovered this recipe, because we discovered it through an autopsy process. During the savings and loan debacle in 1984, we looked at every single failure, and we looked for common characteristics, and we discovered this recipe was common to each of these frauds. In other words, a coroner could find these things because this is a fatal recipe that will destroy the banks as well as the economy. And it also turns out to be precisely what could have stopped this crisis. The one that cost us $11 trillion just in the household sector, that cost us 10 million jobs, was the easiest financial crisis by far to have avoided completely if we had simply learned the lessons of epidemics of control fraud, particularly using this recipe. So let's go to this crisis and the 2 huge epidemics of a loan origination fraud that drove the crisis: appraisal fraud and liar's loans. And what we're going to see in looking at both of these is we got warnings that were incredibly early about these frauds. We got warnings that we could have taken advantage of easily because back in the savings and loan debacle, we had figured out how to respond and prevent these crises. And three, the warnings were unambiguous. They were obvious that what was going on was an epidemic of accounting control fraud building up. Let's take appraisal fraud first. This is simply where you inflate the value of the home that is being pledged as security for the loan. In 2000, the year 2000, that is over a year before Enron fails, by the way, the honest appraisers got together a formal petition begging the federal government to act and the industry to act to stop this epidemic of appraisal fraud. And the appraisers explained how it was occurring, that banks were demanding that appraisers inflate the appraisal, and that if the appraisers refused to do so, the banks would blacklist honest appraisers and refuse to use them. Now, we've seen this before in the savings and loan debacle, and we know that this kind of fraud can only originate from the lenders, and that no honest lender would ever inflate the appraisal because it's the great protection against loss. So this was an incredibly early warning, 2000. It was something we'd seen before, and it was completely unambiguous. This was an epidemic of accounting control fraud led by the banks. What about liar's loans? Well, that warning actually comes earlier. The savings and loan debacle is basically the early 1980s through 1993. And in the midst of fighting that wave of accounting control fraud, in 1990, we found that a second front of fraud was being started. And like all good financial frauds in America, it began in Orange County, California. And we happened to be the regional regulators for it. And our examiners said they're making loans without even checking what the borrower's income is. This is insane. It has to lead to massive losses. And it only makes sense for entities engaged in these accounting control frauds. And we said, yeah, you're absolutely right. And we drove those liar's loans out of the industry in 1990 and 1991. But we could only deal with the industry we had jurisdiction over, which was savings and loans. And so the biggest and the baddest of the frauds, Long Beach Savings, voluntarily gave up its federal savings and loan charter, gave up federal deposit insurance, converted to become a mortgage bank for the sole purpose of escaping our jurisdiction, and changed its name to AmeriQuest and became the most notorious of the liar's loans frauds early on. And to add to that, they deliberately predated upon minorities. Right? So we knew again about this crisis. We'd seen it before. We'd stopped it before. We had incredibly early warnings of it, and it was absolutely unambiguous that no honest lender would make loans in this fashion. So let's take a look at the reaction of the industry and the regulators and the prosecutors to these clear early warnings that could have prevented the crisis. Start with the industry. The industry responded between 2003 and 2006 by increasing liar's loans by over 500%. These were the loans that hyperinflated the bubble and produced the economic crisis. By 2006, half of all the loans called subprime were also liar's loans. They're not mutually exclusive. It's just that together they're the most toxic combination you can possibly imagine. By 2006, 40% of all the loans made that year, all the home loans made that year, were liar's loans. 40%. And this is despite a warning from the industry's own anti-fraud experts that said that these loans were an open invitation to fraudsters and that they had a fraud incidence of 90%, 90. In response to that, the industry first started calling these loans liar's loans, which lacks a certain subtlety. And second, massively increased them. And no government regulator ever required or encouraged any lender to make a liar's loan or anyone to purchase a liar's loan, and that explicitly includes Fannie and Freddie. This came from the lenders because of the fraud recipe. Right? What happened to appraisal fraud? It expanded remarkably as well. By 2007, when a survey of appraisers was done, 90% of appraisers reported that they've been subject to coercion from the lenders trying to get them to inflate an appraisal. In other words, both forms of fraud became absolutely endemic and normal, and this is what drove the bubble. What happened in the governmental sector? Well, the government, as I told you, when we were the savings and loan regulators, we could only deal with our industry. And if people gave up their federal deposit insurance, we couldn't do anything to them. Congress may strike you as impossible, but actually did something intelligent in 1994 and passed the Home Ownership Equity Protection Act that gave the Fed, and only the Federal Reserve, the explicit statutory authority to ban liar's loans by every lender, whether or not they had federal deposit insurance. So what did Ben Bernanke and Alan Greenspan, as chairs of the Fed, do when they got these warnings that these were massively fraudulent loans and that they were being sold to the secondary market? Remember, there's no fraud exorcist. Once it starts out a fraudulent loan, it can only be sold to the secondary market through more frauds, lying about the reps and warranties. And then those people are going to produce mortgage-backed securities and exotic derivatives, which are also going to be supposedly backed by those fraudulent loans. So the fraud is going to progress through the entire system, hyperinflate the bubble, produce a disaster. And remember, we had experience with this. We had seen significant losses, and we had experience of competent regulators in stopping it. Greenspan and Bernanke refused to use the authority under the statute to stop liar's loans. And this was a matter first of dogma. They're just, horrifically opposed to anything regulatory. But it is also the international competition in laxity, the race to the bottom between the United States and the United Kingdom, the City of London in particular. And the City of London won that race to the bottom, but it meant that all regulation in the West was completely degraded in this stupid competition to be who could have the weakest regulation. So that was the regulatory response. What about the response of the prosecutors after the crisis, after $11 trillion in losses, after 10 million jobs lost, a crisis in which the losses and the frauds were more than 70 times larger than the savings and loan debacle? Well, in the savings and loan debacle, our agency that regulated savings and loans, OTS, made over 30,000 criminal referrals, produced over 1,000 felony convictions just in cases designated as major, and that understates the degree of prioritization because we worked with the FBI to create the list of the top 100 fraud schemes, the absolute worst of the worst nationwide. Roughly 300 savings and loans involved, roughly 600 senior officials. Virtually all of them were prosecuted. We had a 90% conviction rate. It's the greatest success against elite white-collar criminals ever, and it was because of this understanding of control fraud and the accounting control fraud mechanism. Flash forward to the current crisis. The same agency, Office of Thrift Supervision, which was supposed to regulate many of the largest makers of liar's loans in the country, has made, even today, it no longer exists, but as of a year ago, it had made 0 criminal referrals. The Office of the Comptroller of the Currency, which is supposed to regulate the largest national banks, has made 0 criminal referrals. The Fed appears to have made 0 criminal referrals. The Federal Deposit Insurance Corporation is smart enough to refuse to answer the question. Without any guidance from the regulators, there's no expertise in the FBI to investigate complex frauds. It isn't simply that they've had to reinvent the wheel of how to do these prosecutions. They've forgotten that the wheel exists. And therefore, we have 0 prosecutions, and of course, 0 convictions of any of the elite bank frauds, the Wall Street types that drove this crisis. With no expertise coming from the regulators, the FBI formed what it calls a partnership with the Mortgage Bankers Association in 2007. The Mortgage Bankers Association is the trade association of the perps. And the Mortgage Bankers Association set out, it had the audacity and the success to con the FBI. It had created a supposed definition of mortgage fraud in which, guess what, its members are always the victim and never the perpetrators. And the FBI has bought this hook, line, sinker, rod, reel in the boat they rode out in. And so the FBI, under the leadership of an attorney general who's African American and a president of the United States who is African American, have adopted the Tea Party definition of the crisis, in which it is the first virgin crisis in history conceived without sin in the executive ranks. And it's those oh so clever hairdressers who were able to defraud the poor, pitiful banks who lack any financial sophistication. It is the silliest story you can conceive of. And so they go and they prosecute the hairdressers, and they leave the banksters alone entirely. So while lions are roaming the campsite, the FBI is chasing mice. What do we need to do? What can we do in all of this? We need to change the perverse incentive structures that produce these recurrent epidemics of accounting control fraud that are driving our crises. So we have to first get rid of the systemically dangerous institutions. These are the so-called too big to fail institutions. We need to shrink them to the point within the next 5 years that they no longer pose a systemic risk. Right now, they are ticking time bombs that will cause a global crisis as soon as the next one fails, not if, when. Second thing we need to do is completely reform modern executive and professional compensation, which is what they use to suborn the appraisers. Remember, they were pressuring the appraisers through the compensation system, trying to produce what we call a Gresham's dynamic, in which bad ethics drives good ethics out of the marketplace. And they largely succeeded, which is how the fraud became endemic. And the third thing that we need to do is deal with what we call the 3 Ds: deregulation, desupervision, and the de facto decriminalization. Because we can make all 3 of these changes, and if we do so, we can dramatically reduce how often we have a crisis and how severe those crises are. That is not simply critical to our economy. You can see what these crises do to inequality and what they do to our democracy. They have produced crony capitalism, American style, in which the largest financial institutions are the leading financial donors of both parties. And that's the reason why even after this crisis, 70 times larger than the savings and loan crisis, we have no meaningful reforms in any of the 3 areas that I've talked about, other than banning liar's loans, which is good, but that's just one form of ammunition for this fraud weapon. There are many forms of ammunition they can use. That's why we need to learn what the bankers have learned, the recipe for the best way to rob a bank, so that we can stop that recipe, because our legislators, who are dependent on political contributions, will not do it on their own. Thank you very much.
All right, thanks for coming back. So what did you think? What do you think of Bill Black? What do you think of what he has to say? Does it change your mind about how banking regulations need to be reformed? And do you start to understand about what I meant in the beginning? It's a choice. It's our choice. Do you understand that the federal government is not financially constrained? If there are banking regulators that want to regulate the banking system and they are available and they want to do it, the federal government can hire them in whatever capacity they exist in. The federal government can afford to do it if the federal government chooses to do it. They're not going to do it unless you rise up and tell them to do it and make them feel the pain of what happens when they don't do it. Make them fear the loss of your vote. I'll be back next week. Bye-bye.